Hello, I'm Howard Green. Well, S&P gave Britain some breathing room today, raising its outlook on UK debt to stable from negative, taking pressure off of the country's AAA rating. This after the British economy grew more than forecast in the third quarter, and a week after the Conservative government of David Cameron got tough with British finances, cutting £81 billion from spending, the most significant tightening since World War II. 500,000 public employees are losing their jobs. Ministerial budgets are being sliced by 19%. The retirement age will go up to 66, and even the Queen will take a 14% hit to her budget, all to bring down Britain's deficit, which sits at 11% of GDP. So is this the right course of action? And if so, will it work? Joining us to discuss this today are, in Toronto, Alex Jurshevski, managing partner at Recovery Partners. He has worked on sovereign debt issues with New Zealand, as well as countries in Northern and Central Europe and Central Asia. And we hope to have, in a few minutes from now, from London, Martin Wolf, columnist for the Financial Times. He has written extensively on sovereign debt. Good to see you, Alex. Thanks for coming in.
No problem, Howard. It's good to be here.
So this latest from S&P, how significant is it in your view?
Well, I think it's a vote of confidence in the steps that the government is taking. The deficit at 10, 11% of GDP was clearly unsustainable. They had to take some steps to cut back. I think where they're cutting are the obvious areas. Whether this is going to be sufficient to bring things back into balance in a short enough period of time, we'll have to wait and see. I think the jury is out, but I think the vote of confidence also came from the bond markets. Gilts have rallied over the past week since the cuts were announced.
Those are the equivalent of treasuries in Britain.
Exactly, UK government debt. So I think all round, I think this is the right move. I think we need to see more of it from some other countries.
What about the rating agencies? Just one more question on that. How much attention do people pay to those things since the crisis?
Well, even before the crisis, I think it's pretty important to get a good opinion from the rating agencies, because of a lot of investors look to those credit ratings in making their investment decisions.
Still,
absolutely. It's just an article of faith that most investors place in these ratings, because that's the way they have done it. You need an objective rating in order to be able to make an investment.
Even if they are at times conflicted.
Even if they're at times conflicted. I mean, most central banks have repo rules that dictate, what type of collateral they can take. It has to have a credit rating attached, typically single A or above. The same for commercial banks. So the credit rating agencies aren't going away anytime soon, and the UK Debt Management Office, the DMO, and the Treasury there are right in paying the appropriate amount of attention to making sure that the rating agencies understand what the government's plans are and agree and provide their stamp of approval.
So what about the plans themselves? Can you go through that, the British plan, and what you think of the details of it?
The detail, I mean, they're cutting spending to local authorities, which I think is good. That's highly bloated. They're cutting back the pension envelope. They have to. If we look at just three components of the UK budget, education, the National Health Service, and pensions and other benefits, that now constitutes about 62% of the total expenditures of about 1.1 trillion. 40 years ago, those numbers added up to about 30%. So the UK budget has got built into it a lot of rigidities which have to be removed in order to make the economy more flexible and responsive. We've got to get rid of some of these entitlements. The local authorities in the UK are notorious for wasteful spending, overspending. There's a cut of about 25-27% projected there. This is all good news.
What about how the British population may have changed, though, in that period? I mean, are there needs that are going to be sacrificed through this?
Absolutely, but I think we're dealing in a different world. I mean, we're not dealing in a world where, we're going to get 3, 4, 5% growth accompanied by 2% inflation and 5% unemployment. I think we're moving into a world now where your inflation-unemployment trade-off is more like 8 to 10% inflation, 8 to 10% unemployment for 2% inflation and maybe 2% growth. That's kind of the profile we're going to be seeing now over the next 5 to 10 years as the world digs itself out of this hole. Sure, the cuts are, falling more heavily in the UK on lower income people, but that's just the reality of where most of these entitlement spending programs target in the first place. So if you're going to cut the entitlements, well, they're targeted at poorer people are going to suffer.
But is there a risk that Cameron could be Britain's Herbert Hoover?
Absolutely. We don't know what this is all going to mean in 6 to 12 months. We do know that the markets have provided a vote of confidence. I personally think he's making the right moves. If, however, the world economy goes into another double dip, they could end up taking the blame as having taken some of the stimulus out of the economy just when it was, the recovery was gaining some traction. That would be the argument that's being made. I personally don't subscribe to that argument. I think that you're dealing in a multipolar situation here. There are a whole bunch of countries that are in similar difficulty with large deficits and funding problems. And, it's my conviction that over the next 1 to 3 years, you'll see a couple of those sovereigns fall into default. You don't want to be in that group. And I think Britain's taking appropriate steps to avoid being in that group of sovereigns that are going to be targeted by the hedge fund vigilantes, the bond vigilantes, and are going to have a lot more trouble.
We've talked about that before with respect to Ireland. Well, Greece, obviously, but Spain, but also Ireland, I think the last time that you were here. And Ireland went ahead with very tough austerity measures, yet even since then, it has come into the crosshairs of those people that you just talked about, hedge fund vigilantes bond vigilantes.
That's right. And, another country is Iceland, and there's Latvia, and there's a lot of countries that are still at risk because the problems that they have to deal with are so large in relation to the economy.
But I guess my question is, if you go ahead with these austerity programs and then you're still a target, so how do you win as a society in these situations?
It's basically you're running away from a grizzly bear. All you have to be is faster than the slowest guy in the group. And as I mentioned, you don't want to be in the group of sovereigns that go down the tubes because they haven't taken proactive steps. They haven't adopted debt to GDP targets. They haven't adopted a policy of spending restraint and in an effort to bring their funding exposures under control. Because this can't go on for many of these economies. They can't simply go back to the bond markets time and time again, tap the bond markets for deficit financing. At one point, the markets are going to recoil. They're going to react badly. They're not going to take the debt. And then you're in a default situation. You want to avoid that at all costs.
I mentioned the Herbert Hoover analogy earlier. Why not the FDR approach? Spending to prime the pump. I mean, Paul Krugman of the Times, who you may or may not read, said, why not wait till the recovery's underway before you start to do this kind of cutting? They're going to cut 500,000 public service jobs there.
Absolutely, and that's well merited. They have far too many public employees in Britain, in the UK, in the US, and in other countries. You need to do this pruning now. You're not going to get another chance, another bite at the cherry. You're running a public sector deficit in the UK of 10 to 11% of GDP. It's completely unsustainable, and unless the bond markets this is what the bond market reaction is telling us. Unless the bond markets get some evidence that there's credible public sector finance management in place, that this borrowing profile isn't going to go out of control and cause debt to GDP to skyrocket without end, you're basically going to have you're going to have a vulnerability to those markets. You want to remove that vulnerability because even on current forecast, you're still going to have a very large public sector debt to deal with in the UK.
Does this tell you that the UK will avoid a Greece-like problem?
No, but it tells me that they're taking steps to reduce the risk of that happening. As I say, you don't want to end up categorized in the same group with Greece, Ireland, Portugal, when, if there's another round of turbulence. You want to be in a group that's perceived as being a more safe haven. And there are going to be very few of those countries. And most of those countries right now actually aren't Western countries. The perception of China is changing. The perception of many of these emerging markets is changing. And that's who you're competing with when you're having to raise money in a bond auction. You're having to compete with people who have their finances under much better control. That's becoming the benchmark.
Okay, we're going to take a quick break, and when we return, we will have Martin Wolf of the FT in London. Please stay with us.
We are going to bring the years of ever-rising borrowing to an end. We are going to ensure, like every solvent household in the country, that what we buy we can afford, that the bills we incur we have the income to meet, and that we do not saddle our children with the interest on the interest on the interest of the debts that we were not prepared ourselves to pay.
That, of course, was George Osborne, the UK's Chancellor of the Exchequer, and we are now joined from London by Martin Wolf, columnist at the Financial Times. Good of you to join us, Martin. Thanks for making time today. I want to hear from you now on this. We've heard from Alex Jurshevski here in studio saying that, if I can paraphrase, this is the right thing for Britain to do to establish credibility with the bond market. What is your view?
Well, I suppose I probably disagree at least a fair amount. I don't think there was very much sign of a lack of credibility in British finances. Actually, the British government is able to borrow both real and nominal at historically low rates. We clearly needed a credible plan to reduce the structural deficit. I'm deeply unpersuaded that it had to be by the end of this Parliament, and I am concerned that the impact on the economy will mean that while the structural deficit declines, the cyclical deficit will actually rise. So the overall effect on the actual deficits may be much smaller than Mr. Osborne hopes and expects.
And I've read what you've written about this, that this could curtail growth by 1 or 2 percentage points of GDP per year. Is that correct?
I was just using the latest study by the IMF. It has in its World Economic Outlook, it has a chapter that discusses the impact of fiscal tightening, particularly on countries which already have interest rates at the floor. Short-term interest rates in the UK are close to zero. So monetary policy is, I think, pretty well blocked. I don't believe quantitative easing will do very much. So in that context, using their numbers, it is possible that, as I said already, that the net impact will be such that growth will slow. We don't know. We will see. And if that is the case, the cyclical effect on the fiscal deficit may be really quite adverse, and the overall impact may be much less favorable than he hopes. We can see this in other countries. Ireland is having this difficulty. It has a very considerable fiscal tightening, and leaving aside the enormous bank debt problem it has, it's still finding it very, very difficult, in fact, to close the deficit because the GDP isn't growing. You need GDP to grow to manage the fiscal problems of any country.
Yeah, but this is the problem we're having now, because we're looking at a slow growth world for most of the developed economies, and there's no way out. You can't simply prime the pump and expect that this is going to have a positive impact on growth. You know, I challenge anyone to tell me historically where this has had a positive impact. The net effect of fiscal pump priming is actually negative when you actually add up all the second order effects. You've got to take control of the debt, and the countries that are going to be perceived as being better at that over the next few years are the guys that are going to survive what is going to be a very long period of slow growth and punctuated by potential additional bouts of volatility.
Martin, your response to that?
Yeah, well, obviously we just disagree. The evidence of expansionary contractions is, I think, very, very slender. In situations of this kind, which are fortunately very, very rare, we don't normally have a situation in which monetary policy is so ineffective. This is pretty well all you have. I see not the slightest evidence for a host of major developed countries that they're having any problem in funding themselves. I think this is basically a myth. And the reason they're not having any problem is that the private sectors of the developed world are running absolutely enormous financial surpluses after the crisis. They're deleveraging. There is a talk that we can all go and buy emerging country bonds. I think your guest talked about China. Well, China isn't selling bonds. There's nothing to buy there. So in the end, if you are running a huge financial surplus in the private sector, households and corporations, you have to buy government bonds which are relatively good. Now, clearly, the UK needs to be in that category. I accept that. But I see no risk to the US, Germany, France, that they're suddenly going to find it impossible to borrow over the next few years.
What about that, Alex? Because this week we saw those TIPS in the U.S. Get snapped up at negative yield.
Well, yeah, you've got a temporary situation where there's a lot of liquidity sloshing around because of the money creation. And yeah, you've got a bid in the market. But is that going to last? Are we setting ourselves up for an accident? I was a public debt manager. You try selling bonds in a bear market. In '94, we had auctions fail in the U.S., in Germany, in the U.K. We didn't have it happen in New Zealand. But, you go through a bear market, you have some of these auctions fail. The state of finances in many countries right now are such that it would be unsustainable. Greece, if an auction were to fail in Greece, or if you had a situation in some of these other countries, they're down the tubes. And then you've got a systemic problem because, particularly in Europe, with the size of the cross-border exposures, if one of these guys goes down, you want to make sure that you're protected, your finances are robust, your ability to raise money is intact, and there's no room for error in these situations. That's my point. You want to be as careful as possible and adopt as safe a strategy as possible in relation to your deficit profile and your borrowing requirements.
So Martin, to you on that what-if scenario, what if one day there are no buyers for the bonds?
Well, as I said, if there is truly no buyers for the bond, it's because we've got a wonderful recovery. That's, by the way, what happened in '94. Greenspan started raising rates because the economy was recovering strongly. Once we got the recovery, all these problems go away. As long as we don't have the recovery, and I don't think we're talking about a year or two, I think we're talking many, many years of deleveraging. This has been a huge financial crisis. It's a completely different sort of world from the one we're experienced. I think we're going to find the private sector is going to be continuing to run huge surpluses. As long as that's the case, they're going to continue to buy bonds. I think the real danger, on the contrary, is if the US, Germany, the UK, France, all the big countries in the world, Japan too, all go through the fiscal ringer now, we'll just have a monstrous recession, if not a depression. Now, obviously, the question you're really asking yourself is, do you think that we are in a situation that could easily be the 30s? My view is absolutely yes. If you share that view, then the worry is that tightening will be excessive. Of course, if you think we're in completely normal circumstances, nothing serious has gone wrong, then of course we may be in the fiscal crisis situation that's been outlined. But I think that's really very, very far from where we are.
Well, that comes back to my earlier question to you in the previous segment, Alex. Could David Cameron be the next Herbert Hoover?
Well, he could, but again, we're not in a normal situation. We're not in a scenario where you've got, an unemployment inflation trade-off where you're going to have 5% unemployment and 2% inflation.
I think that's Martin's point. He's saying it's not a normal.
I agree with him. I agree with him. I think we're in a scenario where you're looking at 8 to 10% unemployment, maybe accompanied by 1.5 to 2% inflation and 1 to 2% growth. That's the scenario we're going to have now for a long period of time as this deleveraging process goes on.
Martin, what's the risk of serious social unrest in the UK as a result of this?
I suspect that the UK remains, every decade is new, but the UK remains a fundamentally stable society. It's not France. The British are pretty good, even now, at the stiff upper lip, I think more so than Americans, in fact, and that unless we have, even if we have a very severe recession, the country will survive, the social order will survive. The worst comes to the worst, the government will fall apart and we'll have an election and we'll have a new government and life will go on. But I think, to come back to the crucial point, in a world where the private sector is deleveraging, that is to say, it's saving, it's accumulating assets and decumulating liabilities, the government has to take the opposite position. There's just no other way to avoid a depression.
No other way to avoid a depression, Alex?
Well, I don't think we're necessarily standing on the precipice of a depression unless there's another financial accident, and perhaps unless the U.S. remains committed to this course of additional QEs to get themselves going.
You've said perhaps QE3, QE4.
Yeah, well, I think I would feel a lot more comfortable going to bed at night if some of the policymakers would cut back on the verbiage, retreat from a position that we can all get this back to normal only if we did X, Y, and Z. The reality is we've got a balance sheet recession. There's a solvency problem in the banking sector in a number of economies, including the UK and the US. And until we get through these problems, we're not going to be able to go back to something resembling, 4 to 5% growth and, 4 to 5% unemployment and 2% inflation. We're not going to be able to get there. We're going to have to go through some tough times. And I think the communications effort from the UK government relating this to the electorate, relating this to their fellow politicians, was a very good effort. I think one of the things you need to have in these scenarios is political unity around a strategy. And a strategy of keeping your finances in good order is a good one in a situation where everybody else is going to hell in a handbasket.
Last 20 seconds to you, Martin. How dependent is this on the coalition?
Well, obviously, the coalition has to survive since I think the fundamental economic assumptions are Neanderthal and pre-Keynesian. We understand now that the public sector has to offset the private sector in these situations, so I disagree with what's been said. I think the coalition is going to have a lot of difficulty because I think it won't work economically. But I pray it will work economically because I want my country to succeed.
Gentlemen, thanks to both of you for your time today. That's Martin Wolf of the Financial Times in London and Alex Jurshevski of Recovery Partners here in Toronto. Headline will return in a minute.